Hello, everybody. Joshua Hayes at BigWaveTrading.com. Hope you had a wonderful week. Hope it was profitable, but I tell you what, it sure was choppy. And unfortunately, the price action was really bad. We violated many key levels on the indices that I wanted to see hold, especially this uptrending 50 on the SPY. And we're just going to do the SPY. Now, first off, I want to mention, guys, price volume. That's all that I really pay attention to. These indicators down here are tertiary. These indicators that you see on my charts are secondary. And if you want to see it get real nuts, bam, all of that is secondary. Price action is all that really is key for me. And what I want to show you right now, how the moving averages can help you with the overall market. That's the only reason why these are on the screen. I just want to show you how they can help you within the context of an overall market to know if you're in a good market or not. But the first things first I'm going to discuss is the price action that actually happened. We had really good CPI numbers, but amazingly, and something that I did not expect at all, that was the top tick. Powell was very hawkish the next day, further hawkish commentary the next day from the ECB, Bank of England, and then quadruple witching did not go well. And 3 days in a row, sold off 3 days in a row following the gap up on heavier volume. And if you count the intraday reversal, nasty 4 days of heavier volume selling intraday on the SPY. Not good. Now, that being said, following Friday's session, I got a ton of price volume properly structured signals. So here's the thing. Is this a raging bull market? Once again, look at these moving averages. Look at the overall trend of them. This is the 200. This is the 150. This is the 100. This is the 50. These are the key moving averages for me on a daily time frame. Now, on a shorter term time frame, I don't know why I can't talk this morning, guys. I apologize. Like I said, I'm not an editor. I'm not a videographer. I'm a trader trying to make videos to make you guys money, or more importantly, in this market, save you money. So the short-term moving average, you can see the 5 is below the 9. We start to bounce. Is the 5 above the 9? No. We're down here again. We start to bounce. We now have the 5 above the 9. We get above the most important short-term moving average to me, the 21. You could put a buy stop limit order right here on SPXL. Take this trade to the upside, have a break-even stop, get knocked out, and or not have a break-even stop, have a logical rational stop after you enter here. Your logical rational stop would be here, and you're still in the SPXL trade. Now, granted, it's only up 2% now, but to the CPI highs, you had an 8% gain. So there is a way to play the indices only, and sometimes it is best for that. What my point of this video is, I'm going to show you that right now, we shouldn't expect a whole lot. And for those, this uptrend off the October lows is good. It's still technically, I mean, I can draw this uptrend line here, and we violated that uptrend line, but technically we're still trending higher. This is a higher, this is a low, higher low, higher low. We have a reversal day at some point next week when I take all the positive signals that I got on Friday that may or may not be false positives, guys. It was quadruple witching. A lot of these signals that I received on my end, I'm willing to take a trade. But here's the thing. Once again, this moving average structure, okay? I want to show you when you can go heavy into the market. Off the 2020 lows, we had that COVID rally. We had quantitative easing. We had free money by the Fed. But if you want to know when you should get aggressive in the market, look at the moving average stack. Here, the 150 reclaims the 200. We have the dip below the 100. You can get long above the 100 with the stop below this low now that you're properly stacked. And then you can do the same thing. Anytime you violate a key 21, 50, 100, 150, 200 moving average and then reclaim it, you can always get long using a rational stop below the low. This is one way to deal with an uptrending market if you trade the SPY only. I do not trade that way. I look for leading stocks. And by the way, 2020 to those 2021 highs, leading stocks and small caps were amazing. 2021 to 2022 top, big cap stocks and value stocks, they did amazing overall. The signals were pretty lame. It was choppy, but overall, the canceling methodology did work during this time. But using the moving average lines as a guide, we can see that this is what you want to see when you're aggressive. So be aggressive when the moving averages are properly stacked. When the moving averages are stacked like this, it's the opposite. We have the 200, 150, 100. Well, the 100 and 150 are kind of now crisscrossing, and the 50. This is an improper stacking. So here's the thing. We're going to go over a couple of long ideas in this video lesson at the end of it, but let's say normally you would risk $100 from your entry to where you plan on stopping out. I always say dollar amount, whatever you're okay risking. I hear arbitrary numbers out there, 1, 2, 3, 5, 7, 8%. Don't do that. What is the dollar amount that you're okay risking? So let's say that you wanted to take SPY long above this high here and you wanted to risk to this low. Let's say that you're comfortable risking $100. Well, you take the buy stop level, the high of the day, you subtract it from the low of the day, divide it into $100, and that's your size. That's what you get on SPY. In this market, if $100 is a normal risk for me, how much do you think I'm comfortable risking per trade max? If $100 is my normal 1R risk, we're using that number as an easy example. In this market, if $100 was my normal risk, on the best setups with $100 normal risk, I'd risk $10. On any other setup that I didn't quite think it was high quality, but I wanted to give it a shot, $5. So do we understand how we have to modulate size, modulate our positions according to signals? This is a fake out, breakout market. And in fact, I actually have some numbers from institutional Cancelim newsletter. Let me go find those. Okay, so since the October lows, they've recommended about 30 stocks. They've had to cut their loss on like about 20 of them. With the ones that remain, here are the percent returns. Negative 7.7, negative 7.2, negative 4.8, negative 10.7, negative 5, negative 6.6, negative 4, negative 4, negative 6, up 14, negative 7, up 6, negative 6. This is in no indication of the quality of that Cancelim newsletter. It is no indication of the IBD 50 that's hitting a new low. It's an indication of where the market's strength is. It's not in growth stocks. It's not in hot, innovative tech stocks via ARK. It's currently still in stocks like the DIA, like Pepsi, like Coke, your big mega caps. And to me, that indicates that we could be heading into a recession. And on that note, this continues to be the chart that is just the biggest concern. Think about the 2017 rally. What was happening? This light blue line going into the 2017 rally. Retail outflow. What was happening going into the 2018 rally that led us into the top event at the end of 2018 that led us to the 2020 top before COVID? What was happening? During the COVID rally, following the COVID sell-off, what was happening? Then retail starts buying stocks all the way until we top in 2022. And what are they still doing? Buying a ton of stocks. Guys, I have not seen this, and I've only been trading since about 1999 seriously. Actually, to be honest with you guys, seriously, I haven't been trading serious my entire career until just a few years ago. I dicked around way too much, pardon the language, but it is what it is. Either way, I take this completely serious now. I do this for everybody. This is the mark that I want to leave. I want to help people make money. When I look at this and I see this kind of equity inflow during a bear market, the last time that happened, guys, was 2000 to 2003. Retail continued to buy stocks into 2000, throughout 2000. They continued to buy stocks throughout 2001. And then eventually, 9/11 happened. They started to sell. We had our bottom at some point in 2003. So that chart right there concerns me a little bit. Now what I'm showing is a chart of what I happen to see another long-term vet on Wall Street drew this week. This is kind of what I'm looking to have happen in 2023. This is the October lows. This is kind of, this chart that this individual drew is kind of what I'm expecting to play out in 2023. My initial ultimate low target for the SPY was 340. Following what we had the last week, I'm going to move that potential low down to 320 following the very hawkish rhetoric from the ECB, Bank of England, and the Fed this past week. Now, can the Q4 Santa rally happen? Yes, and that's something that I was talking about earlier before I skipped over it. The bullish period is December. I forgot to talk about it. From December 16th to December 31st, since 1950, the annualized return for the S&P 500 is 36%. It's the most bullish period of the year. From December 16th through the 31st, since 1950, 57 up years to 15 down years. However, what do those 15 down years definitely have in common? Anytime the SPY is off by at least 17% heading into this bullish period, 100% of the time, it has been lower. So within those 15 negative years, every year where the SPY has been down 17% heading into December 16th, like the SPY is this year, it happens to be down right around 18% before Friday, the Santa Claus rally does not happen. I'm open-minded. I don't know which way it'll go, but we'll see. But ultimately, I've shown you the moving averages, and now I'm going to show you all my levels. Do you think that there's this many resistance and support levels that you're trapped in between, this many moving averages, this many Fibonacci retracement levels, this many downtrend lines, this many anchored VWAP levels that we need to get over whenever you're uptrending above all the key moving averages? Absolutely not. So even if we do rally in 2023 and find some topping, even if we do roll over and make new lows, I 100% believe it's going to be an extreme chop fest. Now, that being said, on Friday, I got 2 long signals that I want to give everybody because they're very high quality, excellent RR. But once again, am I going to go all in my account in either one of these long ideas? Am I 50% of my account goes into this one, 50% goes into the other, and I expect them to work and I'm going to let them work initially? No. So keep that in mind. You trade and you modulate according to the market you're in. Let's review those 2 stocks. First things first, everybody, I'm going to show you what they look like on my Telechart version 7, which I still use. I think I'm the only one in life that uses it. But I want to show you the overall structure off the lows, what the volume profile looks like, what the balance of power looks like, and what the chart looks like, why we're doing this signal. You can see the volume surge, the BOP surge, overall uptrend, leading stock, leading industry group, nice hammer bar. Similar situation with TITN following an excellent earnings report, pullback, a little bit heavier volume than I like, but a larger volume reversal into that gap fill area with a spike in volume and BOP. Let's get back to my version 20 chart. All right, so with TITN, I really like this stock. This stock sports a 99 EPS rating, a 97 relative strength rating, and a 99 composite rating. 99, 97, 99, pretty good. The only problem is the group relative strength is not in the top 40 industry groups, so it's not flawless. That being said, my game plan for Monday or for the week, as long as it does not close below 37.25 before triggering, is to get long TITN with a confirmation move above the high of the day of 39.41. I plan on getting long at 39.42. I am calculating my risk to 37.24, 1 cent below the low of the day, calculating into the dollar amount I'm willing to risk. And let's once again keep things simple. If you're risking normally $1,000 per trade, I would not risk more than $100 on this trade. In a raging bull market where things are working left and right, where Titan's also part of the top 40 industry groups, sure, let's risk 1,000 on it. That would be a 1R. Maybe I could get like 33% of my account value alone into this name with a 1R risk. In this market, it's just a test trade. I like my chicken money flow, my secondary indicators, but notice I'm not lined up on these. But like I said, these are secondary. I really don't care. I don't have a tight squeeze. I'm not releasing. In fact, TTM trend momentum's going down. So it's not perfectly lined up, but I'm right here at the 21 EMA. It's uptrending. Very clear risk right here. Potential gains back to the old highs and beyond. We'll see if that happens. And then the last one I'm going to go over, already showed you it on the one chart. GFF, once again, proper EMA stack. Also did not show, or SMA stack, Titan 200, 150, 150. Ding, ding, ding. Very rare to get these kind of setups in this market right now, guys, especially in growth stocks. It's not happening. 200, 150, 150. GFF, got to go to my other window, look it up on MarketSmith. GFF, this is also why it's a new long. 99 EPS rating, 97 relative strength rating, 98 composite rating. Industry group, once again, that's the issue. Both TITN and GFF are not in top 40 industry groups. But with GFF, CMF is good. This is the most important tertiary indicator for me. The CMF and BOP, we're green on both. We're green on both on Titan also. But once again, not in full confirmation here. TTM trend momentum is moving lower, but we are releasing from a loose to medium to the tightest squeeze. Once again, with GFF, I want to get long above the high of the day to confirm this move, 35.11. And if it doesn't work, the low is 33.81, and that's what I'm going to risk to. That potential risk for a potential reward of a move back to these highs and a beyond. Now, here's the thing. Remember how I say if you normally risk 1,000, you should only risk 100? Well, here's the other part of this equation. In a bullish, uptrending market, I would calculate my risk to here and give GFF room all the way to 50 SMA to try to work. So as long as it pulled back on lighter volume and was orderly, I would get long and let the stock pull back and then work. With TITN in a good market, as long as it would hold this gap area to the 50 SMA, which is going to move up as we move along, I would give it room to work. I am not giving stocks room to work in this market. Here's the other thing. In good markets, we get long stocks with size, give them room to work, and we calculate our size to a recent low. I'm going to show you another stock that I'm currently long, WFRD, and here's a perfect example of this. So WFRD, I went long on this day, okay? So this is my initial long signal. I calculated my size to this low, high of day to this low of day, but my final stop initially is this low. Now, in a really good market, I calculate my size from this high to this low and risk all the way down to the logical, rational level that's down here. In this market, it's flipped. It's just the other way because you have to adapt to the market you're in, and right now we're not in a healthy market. But here's a third long idea for you, but I'm going to, full disclosure, I am long WFRD. I was also long GFF, but I've been shaken out of it, so keep that in mind. It's just the kind of market that we're in currently. All right, everybody, I'm going to wrap up the video lesson here. Have a wonderful rest of your weekend. Once again, show me some love, guys. I love you guys. I don't make these video lessons for me. I make them for you. Thumbs up, subscribe, share, comment, anything. I would love to build this YouTube channel. So far, it's not going so well. That's all right. I understand. I get what the people want, and they don't want a bunch of real analysis. It's okay. All right, guys. Have a wonderful rest of your weekend. Make it a profitable one on Monday, and I want to continue to focus. While things aren't working on an end-of-day basis, look at what continues to happen intraday. These are the kind of stocks that we focus on intraday, these small caps. I did not trade COSM on Friday simply because I wasn't sure if once I got in, I could sell on TD Ameritrade. And even though it was tradable on Lightspeed and Interactive Brokers, I couldn't trust that either. But still, why mess around with the end-of-day stuff when you can catch trends? This is the breakout. By the way, this is a setup that we explain at Big Wave Trading in the chat room for us day traders. 300% gain in one session, half a session. Yeah. Makes it a lot easier to mess with that than the overall market on an end-of-day basis, huh? Keep that in mind. That's my preferred time frame still. And until we get quantitative easing, capitulation bottom, or a real uptrend with real leadership everywhere, this will continue to be my main time frame.